Good morning. The PIIGS countries are Portugal, Italy, Greece, and Spain. It's a derogatory term that we apply to Mediterranean countries of the European Union because whenever there's a currency or a debt crisis that hits the EU, it's often because of problems there. These countries have a reputation of managing fiscal issues very badly. They borrow too much, they spend too much, and their banks tend to get into trouble much more often than banks in Northern Europe. Ireland also went through a rough patch, and so sometimes you'll see PIIGS with an extra I for Ireland. These tables show how much it costs governments to borrow money from global markets for 10 years. The United States is 4.36%. So new investors lend money to the US for 10 years, and we pay them 4.36% in interest per year. Moving over to Europe, where the PIIGS are, P is Portugal, 3.21%. Italy's at 4%, Greece is at 3.65%, Spain is at 3.39%. US 10-year paper is considered more risky, less creditworthy than the profligate spendthrift PIIGS countries are now. That's what these tables say. Where is China? China's 10-year bond offers a yield of 2.237%. Compared to other economies in Asia, how much more yield does our own Treasury Department have to offer? Israel, a country fighting a war on two borders right now, they're higher at 4.93. The government of Malaysia can borrow for a lower rate of interest than we can. Hong Kong at 3.5. Singapore is at 3.27. Vietnam at 2.8%. Our politicians and Treasury officials are telling us all the time how great everything is because foreigners are so eager to invest their money. They're so eager to lend to the US government. But here's why. A guy with $1 million to buy bonds goes to Beijing and China tells him their yield is 2.2. Our Treasury Department says, give us your money, we'll pay it twice as much. Is that a measure of strength or of weakness? Vietnam at 2.8, US over 4. US government spending and borrowing is like a runaway train now. And a lot of the domestic inflation that we have in the US is because of all the dollars that are being sucked out of investors around the world, sent to the United States, where they're then borrowed and spent. That means that USD, which are in bank accounts abroad, are being brought back to the US, lent to the US government, who then spends the money in the US. What is strange, though, is which foreign entities are buying our Treasury bonds, because central banks are no longer doing so. In fact, for the first time in many decades, foreign private investors have passed foreign central banks' holdings of US Treasury debt. This is foreign holdings of US Treasuries in trillions of dollars. That's 1,000 billions. Since 2012, foreign central banks are holding steady at about 3.5 trillion. But foreign private investors are up 3.5 times during that same period, from about 1 trillion to 3.5 trillion dollars. And with China dumping treasuries in the first quarter of this year, these two lines have since crossed. Looking at the charts again, here is Canada at 3.6%. The United States government borrows 10-year money for 4.36. So right away, a Canadian insurance company or a pension or a mutual fund or an individual investor can make a lot more yield by buying US 10-year paper than Canada. And that is exactly what Canadians are doing. Canada's holdings of US Treasuries went up 37% just since last year. Canadian investors are buying US debt because our rates are so much higher than they can get at home. So looking at this chart, over $100 billion came into the US economy in just 2 years and just from Canada. That's about $300 worth of extra inflation for every American right now, and it's higher taxes and higher interest payments to investors in Canada until maturity. And that's just Canada. Wolf Street has good data on where the US dollars are rolling in from. In the title, he notes that private foreign buying is growing, but not growing nearly as fast as our new borrowing. And his data are just what we should expect given how much risk premium there is now in US bonds. Foreign buying from Europe is now at $2.3 trillion, up over 9% since last year. Where it says here top 6 financial centers, this means it's not central bank buying. Luxembourg and Belgium are proxies for non-government investors in Europe. Ireland is all private. Same with Switzerland, mostly is true of Switzerland. The Japanese are up next. They're up slightly year over year, but in the same range as they've been since 2011. We explained previously that Japan is not going to be a source of new lending for us because now they're running chronic trade deficits and they need to finance those with domestic savings. Many of us know people who wave their credit card around in restaurants or they flash their new watches or new cars, but we've heard through the grapevine that they're actually broke and they're living on borrowed money. That's us. Our officials proudly get on TV after another giant treasury auction that's just sucked billions of dollars out of Asian and European banks so they can spend those dollars in the US. Then they tell us that investors can't get enough of US Treasury bonds. But it's because we're paying some of the highest interest rates in the whole world. A few years ago, the PIIGS countries almost bankrupted the European Union. But today, prudent investors are demanding high yield premiums to move their money from those countries to the United States. This is Wuxi in Jiangsu province. Be good.
Ask, and it will be given to you. Seek, and you will find. Knock, and it will be open to you. Everyone who asks receives. He who seeks finds. And to him who knocks, it will be open. Jesus said, I am the way,